just a bit of housekeeping. If you do have any questions for the panelists, please use the Q&A feature as opposed to the chat feature for those questions, just so it's easier for me to check those out. But if you have any questions for the team or anything, you can put that in the chat function, or if you just want to chat amongst yourselves, feel free to do that too. So as we kick off, it'll be good just to get some brief intros from our panelists. So I'm just going to go in order of how I see you on camera. So if you could start with Esme, just a brief introduction of you and your background.
Sure. Hi, thank you. First of all, thank you so much for organising this kind of conversation. It's definitely needed right now. But my name is Esme Verity. I am the founder and CEO of Atmos, and I work with very early stage founders to help them develop their sort of propositions and their go-to-market strategies. But I'm also just launched a course on how to raise alternative financing for your impact business. I am also the chapter lead of the London chapter of Zebras Unite. We are a founder-led, cooperatively owned movement looking to build the capital, culture and community for the new economy. I'm also a lifetime fan of YSYS.
That's great to know. Bit of random trivia. So Esme was actually part of the panel that hired me for YSYS. So thank you, Esme, for thinking I'm good enough to join.
Of course you are.
Next, can we hear a bit about you, Andy?
Sure. So I'm on the advisory board of YSYS and also a lifetime fan. I think everyone has to say that now. And I currently run an angel investing school that teaches professionals on how to get started with angel investing. I'm quite new on the journey myself. I've made about 7 investments into startups to date. About 10 years ago, I bootstrapped a startup. So I've kind of been on the other side of the fence, building a business without funding as well. And happy to share experiences across that journey. And I've really built myself up as an operator across the last 5-6 years as a product manager. And I currently run a product management consultancy that consults large organizations on getting started with product management. So yeah, I'm looking forward to even hearing from the other panelists today myself as well.
Amazing. And Shosh, Shetty. So we were introduced relatively recently from me on the YSYS team. If you want to just introduce yourself shortly.
Yeah, absolutely. Good morning, everyone. Well, thank you to the team for having me here today. I agree with the others. I think this is really a much needed conversation that's increasingly getting louder. And I'm really happy to hear that. I think in terms of my background is I was formerly in investment banking at Citi, and over the past few years have maneuvered towards early stage companies and working with startups, particularly on financing, fundraising. One of the companies right now I'm supporting is a startup called Bagboard with their partnerships and fundraising. And essentially Bagboard are sort of looking towards evolving Harrier bags into a media format towards driving conscious shopping. And so through that journey, so as from a financing perspective, we've probably raised over £3 million through like a whole host of variety of methods, from angels, corporate VC, obviously the fantastic work that the Innovate UK guys do as well, receiving a grant there, and also most recently a crowdfunding campaign. So happy to also provide some perspectives on that, particularly with crowdfunding being very popular now with a lot of founders. So thanks very much.
Thank you, Shosh. And Jonny, we will introduce via Emily. So yeah, it'll be lovely to hear a bit about your background too.
Hi everyone, so Jonny Voon from Innovate UK. It's my first time with YSYS. I'm sure at the start of my lifelong fandom journey, so I'm looking forward to it. So I've been at Innovate UK for the last over 6 years, funding everything normally in tech, from smart cities, the Internet of Things, 5G, cybersecurity, AI. But now I head up the Sustainable Innovation Fund, which is one of the government's COVID-19 recovery funds. It's about just over 190 million pounds of public money to support businesses. But we've taken a slightly different angle in terms of not just focusing on COVID-19 recovery, which is great, but we want to focus on climate change and environmental sustainability as well too. And in addition to that, we're also looking at equality, diversity, and inclusion impacts. So quite a triple prong approach. So, and I guess a way that we can look at more than just economic recovery and look at other aspects as well too, which is important to us as an organization.
Great, thank you. So we've heard a bit about the backgrounds of all, as you can see, very, very diverse backgrounds in relation to investment and the various ways that you can do that. So just to kick off, going to give like a very kind of broad question for everyone on the panel to open for everyone to kind of give their view on. So when I first got into like the kind of tech startup ecosystem space, it seemed to me that a lot of founders see VC fundraising as their kind of default route, and some even as far as like you know, thinking about fundraising before they've actually really kind of got to grips with their customers or their products, etc. So I just wanted to get your takes on why do you think VC has kind of been seen as a dominant route for fundraising so far, and that's kind of open to anybody.
I'm happy to kick it off. So I think if you think about the news and media, we like to report on things at the edge of our paradigms, so things at extremes, because that's what's newsworthy. So things that are actually unsexy and boring and the typical day-to-day isn't as interesting, you know. So the Kauffman Foundation released a report last year that stated that about 0.5% of new startups actually like raise money through venture finance, and actually about 24% through debt and loans. But that's not as sexy or interesting, isn't it? So that doesn't really make the news. And if we're being honest, like a lot of the companies that, you know, get a lot of the press from the Ubers and the Facebooks actually represent less than 0.0001% of new businesses that are started. So again, like we're operating at extremes in reporting what's newsworthy and what's, I guess, seen as the darlings in terms of liquidation events, fundraising and exits. But actually there's a long tail of everyday businesses that get started usually off customer revenue, their own money and financing, and maybe leveraging some loans along the way, from your local butchers to your local florists to even your internet businesses that get less press but are actually more common.
Yeah, I would totally agree with that. I think if you look at a venture capitalist, they have a vested interest in, you know, lots of them in sharing really interesting content around how to build a venture backable startup, so that information is a lot more accessible. It is everywhere. And so in fact, it's, although obviously it's incredibly hard to raise VC funding, to find out how to do that is much easier. But you know, the reality is, as Andy said, like 99.9% of entrepreneurs will never access VC funding, but that definitely should not be seen as a failure. In fact, you know, the way that I see it is an opportunity to perhaps build an even more responsible and ethical and impactful startup using a range of different financing options that lie between debt and grants and all these kind of grey areas that we know less about.
Yeah, some of this is really based on culture, especially the US culture. We've seen this with universities. Now, I appreciate that not everyone goes through university to become a founder, but if you take some of the big unicorns in the US, a lot of them have been, you know, fallen out from Harvard, or you know, have quit once or twice or never completed it, and it's always seen as almost as a rite of passage to drop out of Harvard or MIT to spin out your first billion-dollar company to be invested in. And the media loves that because it's a rags to riches success story. You know, whether you're an Elon Musk or a Mark Zuckerberg or whomever, it's that sort of story. But in the UK, that's not really the culture in universities. You know, when you go to university, you're not encouraged to drop out and fail to spin out your own business. And the UK university culture and academic culture tends to be quite a bit more longer term when it comes to technology and IP and patent protection, which typically favors the university more so than the person spinning out of it. That is typically what happens. So the narrative around VCs and big money and that sort of investment isn't quite as relevant or as strong here in the UK as it is, say, in the US.
Yeah, I'd have to agree with all the points. I think predominantly it is, you know, culture, media, and there is also a romanticism as, you know, when you're coming in as a founder, you don't have access to the full spectrum of information when it comes to funding. You've got the vision, you're wanting to scale that as quickly as possible. And what you're seeing from yourself, from people you ask, friends, is you're looking at the sort of later stage companies that are going towards exit and making those big losses. So you sort of extrapolate thinking that is the quickest way towards getting there. Now, I think what is, and I'm sure we'll touch on it, is much more sort of appreciative right at the early stages, is more around sort of intellectual capital as much as just getting the financing to get the products in. But it for sure is dictated, you can tell by the conversations, by more around the sort of media and culture that has been sort of driven from that perspective.
Sure. Yeah, all very interesting touch points. I think, yeah, the media, and just like you said, that story of, you know, being at uni, dropping out, getting massive amounts of funding and launching a huge company is very prevalent, and something that is obviously very attractive to people. But as we'll discuss further today, there's obviously different routes into it, and that represents the minority. I had a question for Esme specifically. I know that you're very passionate about purpose-led businesses and helping them get funded. And I was wondering, do you feel like there is kind of like traditional VC is inherently not ideal for an impact-driven startup? What's your kind of take on that?
It's a difficult question to answer, but I would also look at what we consider traditional VC right now. And I think there is a lot of movement for VCs, although they might not define themselves as impact investors. They're certainly moving down the spectrum of wanting to invest in impact-driven, for-purpose businesses, because the market generally is asking for that. LPs are asking for that, and so I think there's a lot of hope. But I also think that for a lot of businesses, it's just not. It doesn't make sense to go down the VC route. It might be the easier option in terms of how much content is accessible for you. But if your business isn't scalable, if you're not looking for an exit, if you're not looking for that kind of growth trajectory, and how, you know, potentially that growth trajectory could damage, you know, the impact you're looking to have, then you need to look at other options, and they are out there, and they could allow you to build, you know, have good financial returns and the impact you're looking for, but on a more sustainable way, rather than this giant trajectory that you need to follow for VC funding.
Mm-hmm. Mm-hmm. Sure, and one of those routes that obviously, you know, still relatively popular, but maybe not approached as or not spoken about as much, is angel investment. And you know, I wanted to kind of get the perspective of Andy, obviously someone that is an angel investor and educates on angel investing. And also I think Shosh can probably bring some interesting perspectives as someone that's also an angel investor. What would you say are the advantages of going down that route? And there seems to kind of be like this general understanding that angel investors are a bit more hands-on with the portfolio companies compared to like VCs. How much truth is there to that, and what's your general kind of approach when it comes to investing in a company? So yeah, Andy and Shosh, feel free to jump in and give your.
Yeah, I think you know, some of the major differences of an angel investor and a VC is that, you know, a VC they market on purpose because they're trying to attract that deal flow, whereas an angel investor, a lot of the times, actually is an individual that sometimes is in and out of the money, right? They could do a property deal and suddenly they don't have money to invest into a startup, so actually they may not even be marketing themselves or putting themselves out there too much, and actually they're putting their own finances at risk rather than other people's money. Whereas a VC is raising money essentially from other people and institutions to actually deploy that money and put it to work. So you have a lot more autonomy as an angel investor. So even though they're harder to find, actually, you know, a lot of the angel investors that I meet along my journey are actually looking to connect on a personal level with the founding team and really buy into that founding team and their vision of the future. You know, so, you know, although we talk about due diligence and thesis, a lot of it with angel investors comes down to that personal connection with the founding team and the belief in the idea. Whereas the VCs, they try and be a bit more formulaic in how they're really assessing their like investments and doing due diligence around their investments. And I think the reason that angel investors are so influential and responsible, given the stage at which they invest at, is because essentially like they're the first people on your cap table. They're going through this fast growth learning journey with you, where you're learning what a cap table is. You're learning what dilution actually means. You're learning actually how to shape that culture from the first steps, right? Whereas when you get to Series A or B or C with VCs, a lot of that is quite molded and quite set, you know. And something that isn't spoken about when it comes to angel investors is that a lot of angel investors often can add significant value at the early stages, but not so much as you start to scale. So a lot of them actually exit through what we call secondary shares. So they get bought out, for example, at Series A by a bigger VC. So there's this underserved market, which there isn't much data on, but angel investors that are actually exiting a lot sooner, still making decent multiples, but having this great relationship with founders during the early days of starting those businesses. And I saw a question in the chat around, like, where do you find the angel investors? And, you know, it's not an easy question, but in the UK, there's a membership site, an organization called UK Business Angels Association. And they have a list of angel syndicates as members on their website. So that's one of many places, which is a good place to start. Another is to really trawl through databases such as PitchBook, Crunchbase, or TechNation has a free one called Datacoms, where you can actually look at the angel investors and VCs that back certain companies in certain verticals. So again, you can really do your research and find out who's actually been actively investing. But as I said, it's very hard to find out who's in and or out the money in that very moment. So it's not the easiest market to navigate.
Yeah, I think to add on to that, the big advantage you do get you get a variety of people have different preferences as angels, whether they want to be actively involved or sit back a little bit. I think the advantage is if you can find someone who has a certain skill set or expertise that can also add value towards the business direction you're going in. Now, you also, I think you have the same challenges and difficulties as someone posted that question of trying to find those angels, particularly as well as diverse founders. You tend to not have those captive networks that tend to get that level of financing. So I think that's a really good place to start, is the UK Business Angel Association groups. They do, I think I suppose found that there are some which almost do take quite a long time to go through all the due diligence and processes as well. So it's, you know, to bear that in mind with your timelines. But I think with angels, it's you kind of, the best match is finding someone who's really, you're able to have a much more intimate conversation with an individual and to get them to buy into the wider vision. So I think it's always something that I'm sure, as you said with your first question, is that people overlook that as a very first step. And it's just really just trying to ask around, find on, you know, LinkedIn, there are actually a few good groups as well that are popping out, which are really good. I myself have got new into the safe side. My sort of own angel investment group is getting new into that, and from that, it's predominantly all sort of people from diverse backgrounds learning how to angel invest. So more and more people are interested in getting in. Predominantly start with people who are just maybe, you know, a friend of a friend who's never done an angel investment before, but somebody comes in and they're learning through that journey. So I think it's a really intelligent way of sourcing capital at an early stage.
Great, thank you. I guess in relation to that as well, because, you know, you spoke about various ways you can get in kind of like in front of angels or get on their radar. The last, Andy, you mentioned that you funded seven entrepreneurs so far. How did you initially get in contact with the last entrepreneur you funded, and what was it about the first interaction up until the actual point you sent them the money that impressed you to back them?
Yeah, it's a great question, actually. And you know, this is a good and a bad thing that I'm going to share now, because the last person that I invested in is someone that I've known for 15 years. So it's someone that had an advantage in that they're in my network. I've developed a deep relationship with you already. You know, I've actually even tried to start a business with the person before. So I knew the person so intimately that I knew their values, I knew their beliefs, I knew their strong points, I knew their weaknesses. but they had an advantage with me in that we had this existing relationship. It just so happens that I'm in a position where I could actually back them financially. And initially, one of the things that actually was interesting in this relationship was that the person needed support on business development and literally like building up their pipeline of clients. So I stepped in as head of BD as part of that investment to really build them up to a position where they got up to about 30K in MRR. And that was part of the deal. That was part of the deal, was that actually I'm going to write the check, write it off, and go to work with the startup. And I think some of your best, more hands-on angel investors have that type of mentality where, look, I've written it off, I probably won't make money from it, but I'm going to go to work as if I'm a part of this team and an extension of this team. And that's how it worked in this case. And it wasn't a tech company either. It was a digital agency. So again, like, I invest personally in things that I believe in that are purposeful, but I can see the long-term value that they can create for the world, regardless if it's a tech company or not. And when you're investing your own money, you have the autonomy, of course, to invest in whatever you want, essentially.
Right. So I think just changing direction a little bit, because we have obviously such a diverse array of fundraising routes, and we have different people on the panel that represent those. I wanted to ask Jonny, so as someone that provides grants to various kind of tech businesses, I feel like these opportunities aren't the best publicized, and I feel like there's a lot of opportunities out there, a lot of funding out there, but many people from our community aren't too aware of them. And I wanted to get your perspective on, firstly, what kinds of businesses are best placed to apply for grants, as opposed to potentially some of the other routes that we've spoken about. And also, how do grant providers make investment decisions when there isn't necessarily like a profit motive behind them?
Yeah, it's quite a loaded question, all those. So let's start with the last one, actually, because that's the easiest one, I suppose, to answer. So we are halfway between the seed and sort of the angel investors, in that we look at the team, but we also, a bit like VCs, in that we have very specific qualitative and quantitative metrics that we evaluate against, or we assess against. And the important thing to remember, the difference between what we do from for example, an angel versus a grant, is that we focus on the idea. Okay, and that's quite key. So it's an idea, and typically at Innovate UK, we have a big idea. This big idea could be 10, 15, sometimes 30, 40 years in the making. It is the future of nuclear technology. It is quantum computing. It is stuff that is science fiction that we see only coming to market in the next couple of decades. So it's hard often for businesses and startups to think, how on earth do I fit into this grand idea and this vision? And the important thing here is that we look at projects purely from, more from a critical thinking point of view. And not a lot of people will sort of know this, but we ask all of our assessors to consider the critical thinking way of assessing, which is looking at facts, looking at inferences and assumptions, and less so about big, bold statements. So I appreciate that a lot of founders will have amazing pitch decks where they have a great sell with as few words as possible. But typically what we need is evidence. What we need is to reassure ourselves that we, as a public body using your tax money, because remember, this is your money that you pay in taxes that we invest essentially on your behalf, are satisfied that this isn't a scam, that it's going to be as true as possible, that it is, the evidence is clear, that the chance of success is as high as possible. So when we look at how and why we don't publicize this as much, it's because it is often so big a scale that it actually gets lost in the messaging. Right, so sometimes when I say we're going to spend £100 million on grants for businesses, you think, what? But I only need 20K. How on earth will I fit into that? And a lot of the times where we fail is because, being a public body, we can't sing and shout and dance about what we do, and we've also been very bad at doing that as well too. But what we are doing better is highlighting how easy it is, or how to get a grant. And how it impacts businesses. So people like Shosh and others who have gotten grants before, what is the process they've gone through? How could it be made easy for them? What are the steps you need to consider? Make it take away from the headline 190 million pounds and make it about your business, about your idea, about your thoughts and how you think it could help. And so for us as a grant funder, we are torn between a long-term vision, 10, 15, 20 years, looking at macro factors such as economic recovery from COVID-19, recovery from a global pandemic, global climate change, for example, and focusing and talk through that and helping you as a founder with a team, with an idea that will maybe get us partway along that journey. And for us, it's almost less about the tech and more about the impact and the output that your project is going to achieve. And I think that's quite key. And we were talking about VCs earlier, and actually I've had VCs approach me and say, look, we've got these founders, these companies where they're just not ready for VC funding. As Esme said, they're not ready to scale. They don't really have a solid business plan. They haven't thought about their project team. They've got no skills there. What can they go through your process first? And more than happy to. The Innovate UK process is very structured. You need to provide a Gantt chart, a detailed Gantt chart, an exploitation plan, a risk register. You come up with, detailed financing. We ask you to account all the way down to the penny of public money. So all that sort of business practice that an angel can help you with in terms of here's how you create this pipeline. Here's how you create better business practices. Coming through the grant process sets you up nicely for follow-on funding. And I think it's a nice story when all of those work together rather than all compete together for your time.
That's a very good point, how these kind of different investment kind of routes can all kind of play into each other. And it's not kind of one or the other. You can kind of mesh the various ways. Shosh, so you're somebody that's kind of had experience with multiple ways of raising funds, obviously as receiving grant funding, angel investment, VC investment, etc. But one interesting route you've also used to raise more recently is via crowdfunding, and that's something that is I think is relatively new as far as strategies that people have used, but there's been a lot of success that some startups have had using crowdfunding to raise investment. So I wanted to hear from you, why did you go down the crowdfunding route with one of the companies you're working with now? And then also, what general advice would you give for deciding whether crowdfunding is best for your startup, and what is general kind of good practice for a crowdfunding campaign?
Sure, yeah. And I suppose just to segue from the point Jonny was mentioning about Innovate UK grant, I think one of the things that not a lot of people are as aware, but is a fantastic thing they do, is some of the grant fundings is also backed by a strategic that they have. So for example, one of the grant funds that we went through was sort of an ocean plastic grant fund, which was coordinated with Sky Ocean Ventures. And we didn't anticipate to try and get corporate venture funding at all, but we got luckily through the Innovate UK route, and was also able, and I think that's fantastic for businesses to also get strategic support as well as part of that. And I think on the crowdfunding perspective, I think one of the key considerations, I think for anyone who really goes through it is, do you have something that is, a consumer offering as well? Because that, you're not only trying to get financing, you're also trying to increase your consumer base, adoption, etc. And I was touching on just before we started with the conversation with guys that I think right now it's a very hot thing, because particularly as well in the US, a lot of sort of traditional companies who aren't even startups are going through crowdfunding, brick and mortar stores that have an audience and trying to leverage that audience towards getting funding. I think the thinking on the crowdfunding campaign with one of the companies was that we were actually, there was a lot of considerations that we did. We actually wanted to do a very sort of quick angel round, and because of COVID, etc., a lot of those conversations, people tended to go for protecting their own portfolios at that time in terms of getting doing new investments. So one of the things is this was sort of a year ago, sort of end of 2019, and when you're looking at all the alternate terms of funding, we were always anticipating on doing a large crowdfunding campaign. But given the scenario, mainly because we also, if you have it in your mission and your ethos towards consumer ownership, it's it makes sense. But then part of it is because of the current macroeconomic situation with COVID, there's a lot of pressure that you get from conversations around valuation in terms of doing pressure on doing a sort of a lesser valuation than you really can justify, so doing a down round. And as part of that, I think to avoid that, right now a typical crowdfunding campaign that most people are familiar with is almost like straight equity. Anyone can go in, get a bit, put anything in from £10 to £25,000, whatever you want, and get equity shares straight away. For us, what made sense, just because of that conversation around trying to do the upwards momentum that we were on and trying to dictate the valuation, we looked at a convertible of doing as a crowdfund. And without going into sort of too much detail of those things, because I know Andy's got a great dictionary of all the different ways with all the terms. There was the government are at the moment, because of COVID, are offering something called Future Fund, which essentially matches any private investment that you get through a convertible loan note. And what that means, there are pros and cons with all of these things. It just means there's EIS tax relief that a lot of investors are interested in that you can't get through the Future Fund, which is a bit of a con. But the big benefit of doing a crowdfund with a Future Fund as well is that anything you get through the crowdfund, the government will essentially match as convertible loan note. So that has been really attractive for a lot of companies. It's what we ended up doing. It also means that we don't also have to set the valuation right there and then during COVID, and we're also getting new users. And so, yeah, I think I suppose can go in a different conversation in terms of my sort of experience of advice of how to prepare for a round. But in terms of like looking at sort of key factors of doing that campaign, it is, you have an audience that you really want to galvanize and get more adoption of users. And are you also able to sort of, if you've got an existing community of investors who can also back you with pre-committed capital going into that crowdfund, it gives you a lot of momentum, and there's a lot of awareness and PR that you can get from it. And I'd say probably like also just to be wanting to give both sides of the argument, there are drawbacks as well. I feel in that with a crowdfund, it's not, I think I've spoken to a lot of founders, and their main takeaway is when they go into a crowdfund, as I would do when I did my went through, but they just think they open it up, it's a shop window, and people are just going to come pouring in and start, sort of fully funding. You need leads before you go in. You need to be like actively, like any investment effort, getting people in. People just don't come in, especially with the amount of traffic there is on different sites. So that is happy to delve in deeper, but that's sort of an overview of our thinking as we went in and did it.
Thank you, Shosh. No, that's really, really insightful. I had a question I wanted to open up to the whole panel, and I'm conscious of time, so I'll kind of like prioritize questions from the audience a bit, but this is one of the questions that somebody sent in prior to the event. So within the community, there's going to be people, and particularly bearing in mind that when we're talking about diverse founders and kind of thinking about socioeconomic situations as well, you're going to have founders who may not have access to family or friends with a substantial amount of cash who can help them do a family and friends round or raise pre-seed. So as someone from that kind of demographic, what would be the best way to kind of overcome that barrier? So I'm opening that up to the panel, but Esme, I want to kind of get your perspective first, because I know that with the work you do with Zebra Unite is very much kind of focused on funding underserved founders. So yeah, how do you think someone like that might approach raising pre-seed investment?
I mean, I think the first thing that I would say was was, don't, if you're at that point, super early stage, don't rush to try and find any investment that will enable you to, grow and scale. Like, revenue profit is king. And if you have a business that enables you to get any revenue, even reach profitability, that should be your priority. Because if you can do that, and if you can bootstrap via your own revenue, you will be in a much, much, much better position when you go for investment, or never even go for investment. There are some amazing examples of companies that have bootstrapped. Calendly, for example, is an amazing example who's done that. And just, I think we've forgotten the idea that profit can actually happen for businesses. And, I would always look for that before going anywhere else.
Great. And anyone else from the panel want to add their 2 pence to it?
Yeah, I think I'll just add to that and say, once you really understand your customers deeply, and like whether you actually are solving a problem or unmet need for those customers, whether it's business to business or people, consumers, individuals, it's important to join these communities like Zebra Unite, like YSYS, because they give you access into certain networks that you wouldn't have otherwise. So you haven't got the family and friends around, you haven't got the network. These communities can also give you access. They're giving you access to us on this panel today. So these communities are a great way to just learn about the fundraising landscape, have a community of peers and other entrepreneurs that you're going through this journey with who are at similar stages to you, but also forming connections on things such as the FoundersDoor program and all of these pre-accelerated programs that you run to really like go through the stages of building that initial version of your product and your pitch and going for fundraising. So don't underestimate having communities like this and having almost like a personal board of advisors, if you like, that you can lean on for this type of information and connections. I'm going to have to run, but this has been great. Thank you.
No problem, Andy. Thanks for joining us. So we are, we've hit 11 o'clock. If it's okay with the panel, I just want to give like maybe 5 minutes or so extra, just because we did start a little bit later. And there were some questions from the audience to touch on. So again, one of them that came prior to the event itself was around being a solo founder. So I think in some capacity, all of you mentioned how you look at the teams when you consider whether or not to invest or provide grants, etc. So as someone that is like a solo founder who's building a product themselves, how do you kind of build trust and credibility on the team side if you don't have like, other people as part of your team?
So let me answer this because we get this a lot. We get a combination of, we get all extremes. We get people who are solo founders, we get teams of 20 experts and everything in between. And the key thing here is not necessarily putting down names just for name's sake. So people think, well, if I assemble so-and-so with 7 PhDs and world experts in this, that will help me get a grant. The reality is we look at whether or not those people actually help you deliver your project and your idea. And sometimes having a world-class experts in neuroscience is fantastic, but you've got no project managers. You've got no one there that knows how to manage risk or manage finances or how to produce any exploitation plans, for example. So for a solo founder, what we're looking for is your willingness to understand where you lack skills and where you lack the knowledge and how you go about trying to fill that. So, you may be great with an idea, but you need a CTO. You need someone who is, technically oriented. And as part of your idea, you will recruit for that. And what I ask for in my fund is how you apply any ED&I policies to recruitment. So are you just going to go out and find your mate who happens to be the best person you know, or are you going to go out with proper policies to ensure that you get best representation plus the best person as well, ensuring value for money? So I think there's no easy answer for this as a solo founder, but from a grant point of view, it's recognizing your weaknesses and how you'll address them. And apologies, I do need to go as well too, but thank you.
No worries, Jonny. Thank you for your time. So just a couple more questions from the live questions that came in. So one of them around what's the best way to get constructive feedback on a pitch before going to your angel investors? And yeah, I think Shosh, maybe you can give best perspective on that, but yeah, feel free to jump in.
Yeah, absolutely. I think this ties in actually with a lot of points before, in terms of, I think, you know, these networks like YSYS, etc., are really good in terms of providing that support with the decks, etc. I think you find, you know, a lot of people are very receptive towards giving you know, a second check, etc. And I think on the question in terms of trying to get into, you know, finding the right people, one of the things I used to do years ago is just go into Eventbrite and try and find every single investment event that there was at the time when it was live, and just go there. And I think the same applies to this, is that people are very, you know, receptive to people who are, you know, building something that is taking a lot of hard work and coming, you know, really from a genuine place. And I think a lot of people do want to help people in that journey, and they will often just do it as a way of giving a second check. So as part of that, definitely use the existing sort of networks here in place towards providing that sense check. I think there is what you do find is that whilst there is a general type of formulaic structure that a lot of decks are going towards in how people receive it, like problem, solution, business model, etc. So once you get sort of an understanding from, you know, a help, like I'm sure you guys also help with the sort of pre-accelerator, providing that support as well, is it then just becomes towards really packaging what you have towards in that way. But I just reach out to as many people as possible, and more insight and feedback you get, the better it is.
Yeah, I would just add 2 more points. One of them is, don't wait for, like, you know, feedback. You know, there's never going to be enough feedback for you to feel comfortable. And I think a lot of, you know, especially, you know, people who are in marginalized communities feel like they need to be the very best that they can ever be. It's not going to happen. You need to have these conversations to be able to get the really, really important feedback that you need. And it's going to be painful, and you can't just accept that some meetings you're just gonna have to burn. You know, it's like, I need this so that I can improve, so that I can get, you know, a next meeting with somebody that I think might be right for me. And number 2, I'd always think about who is giving that feedback, like what's their background. If they're not an angel investor, or, you know, if they come from, I don't know, investment banking or a different kind of background, just think about what experiences they've had and what opinion they're giving, because you get so much feedback, you can't accept all of it, and it can be like overwhelming. So like, trust your gut and be like, you know what, this piece makes sense for me in terms of how I want to run my business, and therefore I'm going to make that change in the pitch deck, but I'm not going to make the other change because it's not quite aligned with me. But I'm sorry, I'm going to have to also go. But thank you so much. It's been really fun.
No worries. Thank you, Esme.
Bye.
Yeah. Bye. Cool. So we're going to actually wrap up now and move on to the next session. Thank you, Shosh, for joining us as well. There were a couple of questions in the Q&A bit that were around crowdfunding. So if you don't mind just answering via text, that'll be really helpful for them.
Absolutely. Thanks. It was a great session, and thanks for having us.
Thank you. Take care.
Thanks.